G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and I'm here with Chris Bates from the Alcove Mortgage Specialists. And Chris, I see you're wearing a Rask merchandise jumper. I was convinced you'd be wearing a Liverpool shirt today, maybe even a retro 1980s Liverpool shirt. So congrats, I guess, should be in order for you guys.
Oh, it's funny, when we first started chatting, I was thinking, should I not go and change my Liverpool shirt? But I've got my drink bottle here, so yeah, it should be. It's a bit of an anticlimax, if I'm honest. We've been sort of chance of winning the league's probably been about 3 or 4 months in the making, and so I've slowly been excited over the time. I would like to be in Liverpool right now. It's going to be one hell of a party and street parade in May at the end of the season, but yeah, it's good to get number 20 and equal with Man United. So anyway, that's enough football chat. In other football news, we won our futsal competition last night. A bit of a dynasty is getting formed there. We've won 7 of the last 10 leagues, so over 35 futsals. But anyway, what's been happening in your world, Pete?
Yeah, well, Sunshine Coast, funnily enough, there have been a lot of Liverpool shirts being dusted off this week. So yeah, actually, my mum's a Scouser, so I'm pretty well ingrained in the habits of Liverpool Football Club, even if I'm not a fan myself. But yeah, I guess what's been happening here? Well, it's been election week. An awful lot of people tend to vote early on the Sunshine Coast. I think there's so many people here are either retirees or remote workers or COVID refugees, and I think the levels of early voting here have been really high. Even when I went a few days ago, it was actually packed out. So there's been that. I've also been in the studio a little bit this week with Gemma Mitchell from Rask up in Coolum Beach. So doing a bit of in-person recording as well. So, and I guess, yeah, we're recording this on Thursday, but of course, by the time this goes to air Sunday morning, we may well have a new government announced, or maybe the same government announced. If you look at the bookies, it's all over. I think, I don't know, it may prove to be closer than people think, but it does look, if you look at the bookmakers' odds, we're going to get a second term for Albanese and the Labour government.
Yeah, and I mean, I'm a bit surprised, to be honest. I've been looking at new listings this week and expecting that it's actually a decent time to list, right? There's very little on the market, and you know, a lot of people are back from school holidays and Easter, and you don't want to sell this weekend, but it's not a bad idea to have you open this weekend. I still haven't seen too much come on. I'm not sure if you've seen the same up in Brisbane, Pete, but I bet I'm surprised. I thought there'd be a bit of an avalanche yesterday coming on, but maybe today's the day. So we'll see what happens over the next few days. Spent the Easter period and missed you, Pete, last week up in the Goldie, and yeah, it blows my mind really the amount of development happening up there, and you know, and what you can still buy. You know, I did a bit of RP data sort of time looking at, you know, past sales in lots of different buildings and things like that. And a lot of the older stock is pretty well priced compared to the new stuff, right? It's massively under the price of new towers, and the stuff they're building is, you know, very, very high end often. But there's just so much land, and some of the land they're building on is in areas where it's, you know, low rise. You know, there's a little island just off called Chevron Island, just off the surface there, and you know, it's all low rise, but some big towers are coming, so they're changing the game, and really anything is really, any land available is probably going to get built on there, and there's so much available land. But it's a pretty good spot to go for a week. It's a pretty good life up there, and yeah, what have you been up to over Easter, Pete?
Well, funnily enough, yeah, we've just been around Sunshine Coast. We got away from Noosa a bit, but yes, funnily enough, actually going to Surfers in a week's time just for a break. I guess it's an easy place for us to go because we're still within striking distance of Brisbane for work. But yeah, I think it's an interesting market. Whenever you go down there, you can see why it's such a boom-bust market, because even in some of the really nice areas, there's stacks of blocks that could be developed. Yeah. There's effectively no high limit in a lot of areas. You can build up to nearly 300 meters in some cases. So it's naturally a very cyclical market. I think, yes, I mean, we've seen listings have been pretty low. I've got 2 anecdotes for you, and you can sort of throw in your 2 penneth as well. First one is we've seen just, I mean, this is based off a very small sample, but I've seen just a couple of times in the inner west in Sydney, but also in Brisbane, where you get sort of entry-level properties being listed, and you think, oh, this looks like a really nice one, and then suddenly, bang, it's like sold for like 100,000 over what you're expecting. And what people are telling me is that we've got two sides of politics who are both going to be pushing first home buyer policies. And in Labour's case, the 5% deposit scheme wouldn't come into place until January 2026. So we've got people, I guess probably some investors or even say, well, heck, if they're going to be pumping the bottom quartile of the market, I should be buying now rather than next year when we get this big rush of 5% first home buyers. So that's the first thing. I think it's always a bit dumb when you announce these policies ahead of time, because it just gives people opportunity to arbitrage those sort of gains away, if you like, or those advantages away. So that's the first thing. Second thing I've heard just chatting to other people in the industry around the traps is there's been a big surge of people buying, interstate investors buying in Darwin. So Darwin has been a massively underperforming market since the mining boom. And I think some of those sort of data-driven buyers agencies who tend to go in at scale, they're sort of all looking at Darwin because it's relatively cheap. And I mean, you can do this exercise for yourself. Go on to realestate.com.au and do a filter for houses, say 600 to 800. You'll find probably a third of them are already under contract. So it's actually, not only is it sort of definitely a thing, I've heard of some really big numbers of investors going in, but it's also actually, it's moving the market because it's such a thin and a liquid market. And I remember, because I actually lived in Darwin during the preceding boom, it's a very inelastic market. The market just, the supply is terrible. There's no new supply effectively. So I guess like my take on this, and I'm sure you have a one as well, Chris, is that that's all well and good if you're going into that market, but you can't really complain if it goes tits up, because you're in the end speculating on buying something and selling it to another investor down the track. I think if you're a long-term investor in a city like Melbourne, then it's probably a safer bet in my view. Whereas I think what is happening here is people are hoping to get in first, and then maybe in a year or two or three, sell on to the next person when there's been a spike in prices. And actually, I saw the Cotality figures out this week showed that Darwin prices rose 1.1% in April. So there's not only I'm hearing the anecdotes, I'm seeing it in the data as well. What do you think?
Well, a lot there, Pete. On your first
Sorry,
point,
I've had a coffee, if you can't tell.
Yeah, I need to have a coffee to match you. But I guess your first point, right? So the 5% deposit home loans. I mean, I've just looked at the sports bet. I don't have a sports bet account, by the way. But Labor are $1.08 and Coalition are $8. All right. So they got Brexit and Trump first time round were about similar odds. So don't always believe the money, but they say the money is right, which they made a pretty big bet that Labor are going to win this election. The 5% deposit scheme that they're with no income cap, and it's not starting until January. No, and the city caps are probably at a point now where you can't say they're not high enough, right? And so 5% deposit home loans, a lot of states have got stamp duty concessions as well. And so basically that is, and a lot of people do weren't eligible prior, or we're still getting themselves ready for it. A lot of first-time buyers takes them some time. They've got to rattle the tin around family and friends, and and then they've got to save, and and it's really hard to save that deposit. It's not. But if it's only 5% and potentially you pay stamp duty, you're not, and you can qualify for these schemes, I think it's going to be a huge amount of people wanting to get in, knowing that in January there's going to be a lot more demand created. And so I absolutely agree with you, Pete, that you will see that, particularly at the bottom end. And if you're an investor right now, you'd say, well, where's going to be really strong demand? Well, locations where first home buyers can buy and where they're really going to want to live. And so I'd be looking at places in those capital cities under those price points where you're going to see a lot of first home buyers look to compete because it's not going to take much for there to be an undersupply and too much demand. And so that's your first point. I mean, Darwin's an interesting one. I do think there's been a lot of success in regional investing in the past few years. Adelaide, Perth, and budgets have been really tight for investors, and interest rates have been high. And so investors have been pushed because of their borrowing capacity and because rates are high into lower price points. And then in those locations, you're right, there's a finite amount of supply and markets are getting moved because prices are running, and that's bringing more owner-occupiers in, because there's a bit of FOMO. So the investors are almost creating a mini investment boom. There's a movie that I watched on a plane, and it's called Dumb Money. It's about GameStop, the story of GameStop, where basically it's all about this something called the greater fool theory. And You can basically move prices if you create enough demand. And a lot of people will shoot that down. But if you get a bunch of buyers agents that have got a lot of money coming from all around the country and they're putting it into a few pockets around the country, then there's this kind of self-fulfilling bias. And what happens is that they'll buy something at 500 in 6 months' time or 3 months' time, it's worth 550. You don't go in with all your cash first to the buyer's agent. You just buy one. Let's see how it goes. Even the pitch from the buyer's agencies is don't use all your capacity. Let's get 2 or 3 down the line. Let's just see how the first one goes. The first one goes all right because there is a bit of movement in the market. And then all of a sudden you buy another one, right? And then you get this sort of, and that's the problem with that is you're getting late to the party. There's an analogy of just rocking up at a friend's birthday party. You actually want to be the annoying person 10 minutes early, knocking on the door and saying, can I come in? And they're like, well, I'm not ready yet, And then when the party's in full steam and everyone's on the dance floor, you want to be just sneaking out the back door and taking your money and running. And that's unfortunately the way to play these markets is get in early and run. But that to me is speculating. It's not long-term investing. What you're trying to do is take advantage of market and a bit of arbitrage in the market. So yes, you can do that as part of portfolio, but if it's your one property and you're not looking to buy, then sell and then buy again, then you've got to really question, are these really the long-term markets that you want to have your money invested in?
I agree. I mean, my view has always been I like to try and buy assets that ideally I would never need to sell. So if I decided I wanted to hold on to it for 50 years, then I can. I think, yes, there's a general view. It's a bit like the Wall Street bets theme, as you said, where if you get enough people in, you can actually move the market yourself. And I guess in this is the era we live in now. There's information disseminates much more quickly. And if a buyer's agency takes 50 or 100 or even 150 clients into one small regional market or a city in Darwin's case, well, that is naturally going to move the market. In a city where there's maybe, 700, 800 listings, it doesn't take much of that to suddenly you're actually moving the market in your favor. It's going up. But then, as you said, I guess if you're looking to get in and out quickly, there's a very speculative element to that. And yes, all well and good if you're the first person in, but you don't want to be the last person holding the bag. And yeah, I do remember living in Darwin during the boom years when the mining boom was in full swing. And it was actually annoying. You go to a barbecue and all people were talking about was house prices, the old cliche. But yeah, then, we got maybe a dozen years where nothing's happened. So you can, there's definitely a timing issue there. So yeah, CoreLogic put out, or Cotality put out their index for this week. So dwelling values are up 0.3% to a new high, rising for a third month. Only modest gains in Sydney and Melbourne, though. Bigger gains in Darwin, Brisbane, Adelaide, as mentioned. And also Nerida Conisbee did a really good piece for Ray White, which also looked at the April figures. And I guess Ray White's view is stronger conditions ahead for 4 reasons. Interest rate cuts, the uncertainty of financial markets that's pushing people towards the safe haven of residential property, supply constraints, as you mentioned, it's just not building anywhere near enough for the high immigration program that we're running. And then the policy stimulus of the first home buyer scheme that's due to come. So I guess, look, things could always change, but it does seem that that's the direction of travel.
Yeah, absolutely, Pete. And you got, I guess, channeling Brian Johnson before, saying you want to buy properties that will last, you can own for 50 years. So that's optimistic, desires there, Pete, to live for another 50 years.
I thought you meant AC/DC for a minute. I was like, wrong Brian Johnson.
The different Brian Johnson, the longevity guy. But I agree. Nerida's, he's basically working for Ray White now. And, you've always got to sort of taper what she says now because she is working for a real estate agency group. But it's a very good article. And I agree with what a lot is written in there. Should we just give a bit of a wrap up? Every Sunday at 7 a.m. we do our 2 cents, Pete. And I find every time we do these, mate, we're getting to about 15 minutes before we even crack on into the stories.
We've forgotten the whole idea of the purpose of the 2 cents, which, yes, is to go through the big 3 news stories of the week. So I think as an antidote to some of that short-term thinking, there was an article this week out in, I think it was in Sydney Morning Herald and The Main. So which suburbs do people really want to stay in? And they sort of took a look at those sort of twilight zone suburbs where you can enter, but people never leave. And they looked at some of the the houses and units where people tend to stay for a very long time. And also looked at the factors that would make those suburbs appropriate for that. So I guess the sorts of things you would want to see: family friendly, suitable for all stages of life, which usually means good connectivity to the city or work hubs, but also good walkability. So the ability to get to amenities and shops and entertainment and all of that kind of thing, maybe water as well. I think sometimes a bit of affordability helps. I think it's sometimes hard for people to stay for the long term in some of the super expensive suburbs. But in any case, the suburbs that they picked out: Manly Vale in Sydney for houses, also Woolooware, Cheltenham in Victoria, and then for units, places like McMahon's Point and Seaforth. So yeah, I've stayed in some of those places over the years. Woolooware is a nice spot. Units in McMahon's Point are fantastic. I stayed in an Airbnb there once, and it really is good because you can walk to absolutely everything. So yeah, Chris, this was actually an article that you picked out, and they looked at a few case studies. But are those the sorts of things that you would look for if you were looking to buy a family home for the very long term?
I guess it's just the mindset. I mean, these suburbs in particular, and there's some suburbs they haven't even recognised because the sale volume is actually too little to be statistically relevant, I guess. But when you're thinking about sort of twilight zones, really another way to think about it is forever homes. And if you can buy a property or an investment in a place that is really a forever home location, what you're going to find is that the average amount of time that people stay in those properties is really going to get longer and longer. The climbing the property ladder, there's not many rungs on the ladder nowadays. I think that a lot of people are basically going to get into their first home. They may be upgrading to a house, but then to upgrade into a better house and a better house, and a better house. I just don't think it's feasible nowadays. I think people are going to be having to make many more compromises. And when they do get a piece of land or an apartment that they really want to, that could suit them long term, I think the ability to they'll have to stay there basically. And if you can buy a property in an area where not many people want to leave, every year less sales are happening, which means that supply is getting tighter and tighter. And so these places that are forever homes, I think they're little sanctuaries. Because some people will want to leave suburbs that maybe are great today, but could change tomorrow. And I think the New South Wales planning controls, I've said this many times on the podcast, it's something I've just been sort of delving into a lot over the last few weeks. And Instagram is actually a great portal to use for this. If you sort of look at new developments on there and you start to look at lots, your feed gets filled with a lot more of them. And all of a sudden, you can see the amount of pre-sales that they're trying to drive for new developments, particularly in Sydney, in places like, Rose Bay, Double Bay, Crow's Nest, St. Leonard's, Parramatta, Macquarie Park, Roseville. Like the amount of, potential developments coming down the line. And these are huge buildings that they're looking at in these locations that I think it's just going to be, it's a good little insight to where the world's going to go. And so what you want to do is buy in a suburb where you're kind of protected from those new developments. So if we go 10, 20 years down the line, everything's the same. It's a little sanctuary around the city. Everyone's been living there. No one wants to leave. Everyone just renovates their place. And even when the kids get older and move out, you want to stay there because it ticks your sort of lifestyle. So I think what the best investments are going to be in those, what I call forever suburbs.
Garden suburbs. There's a couple of crackers on Lower North Shore where you feel like, even though you're really close to the city, actually, it's a very sort of livable lifestyle and you're not too far from the water either. So it's interesting as the city evolves. It seems at the moment that the price, there's just too much of a differential between established and new prices, and that's why supply is so constrained. I just think it's too easy for people just to buy established properties at the moment, and it's just not really working for developers. I think they need to be able to charge more for those new builds to actually get the supply response happening. But it will be coming. I'm sure it will as interest rates go down. It just might take 2 or 3 years to get some of those projects out of the ground.
Well, that's a good point, Pete. Whether they can actually sell them and get the pre-sales is another thing. They've maybe got the block of land, they've got the design, they've got all the renders, but can they actually go and sell them? That's going to be the challenge. And I think that the price of them is actually really expensive. And what they're trying to do is target the downsizers or the family market that don't want the older house. They're happy to have something a bit smaller but newer. And the first home buyer that, is looking for something that could, suit them for a bigger runway rather than just a box near the city. So, it's going to be interesting to see how they actually sell.
That's what we're seeing in Southeast Queensland is there's plenty of projects being advertised, but it's very much the sort of premium end. It's either people, holiday homes, downsizers, or people who want an ocean view, or in Brisbane, it might be river views, but there's not much sort of cheap everyday properties. You can do this search yourself if you just go onto the portals and look at the price of new builds versus the price of established properties. You can see why supply is struggling. Let's have a look at the second news story of the week. So inflation figures for the March quarter were released on Wednesday this week. So the way I tend to do these days is I read all of the data releases myself first before going to read what everyone else is saying. I think when I was younger, I used to go straight to what Westpac was saying, or Combank or Comsec or whatever. But I think sometimes there's some value in actually just disseminating the numbers yourself and then looking at the media reports later on. Anyway, the headline inflation figure was 0.9% for the March quarter. So that was a bit higher than what was expected by the market. But there was a few, really dig into it, there was a few sort of unknowns. One was that some of those electricity bill subsidies were unwound in the quarter, particularly in Brisbane. So electricity prices jumped 16.3% in the March quarter, which I guess, in the end, that's just an in and out. We got the subsidies on the way in and then they get unwound on the way out. So I think if you look at the last three quarters for inflation, it was 0.2, 0.2 and 0.9, leading to 2.4% over the year, which is fairly moderate and under the middle of the target band. I think if you look at what the more sort of closely watched measure that the Reserve Bank looks at, trimmed mean inflation was 0.68%, and last quarter was 0.53% revised. So too many decimal points there. But if you annualize the last 6 months, again, 2.4%. So there's nothing there that's going to spook the Reserve Bank, of course, from looking towards easing interest rates. But I think everything they've communicated so far suggests a cautious approach. So they might just drop by 25 basis points in May. That's what the market's pricing anyway. And I think if you look ahead, well, fuel prices should drop in Q2. Just driving around looking for the Puma service station or somewhere that'll do 160 cents a litre or thereabouts now, way down from when we were paying $2.12 at the peak of the market in 2022. I think rent inflation is cooling as well. So I guess the whole point of all this, Chris, is that the average new loan size now in Australia is 600,000. I think you'd know better than me as a mortgage broker. And we've got mortgage rates. A lot of people are paying 6.5%, and those two numbers, they just don't match up. And affordability is at basically a record lows. So I suppose what an awful lot of people in the market are saying is, well, yeah, we need that cut in May, but do we get the three further cuts that markets are pricing? And if so, does that sort of help to sort of stimulate the economy again?
Look, it's a hard one, right? Either rates are going to be sticky, and if that's the case, even a few rate cuts are going to give people a lot more confidence, I would say. And I reckon we're going to, whether we get 4 or 5 from here and take our rates down to high 2s or even lower than that, is unknown. That's what markets are pricing right now. So they're saying there's a good chance that that's going to happen. But even if it's only 2 or 3, you'd like to think there's still going to be a couple. That's still going to build confidence a lot. And, whether inflation comes down and whether they get the 4 or 5, I don't know. But if rates are going to stay high for longer, I still think that, 2 or 3 or 4 are going to be a huge impact to confidence and take a lot of pressure off a lot of households and investors to sell. It's a big difference on a $1 million investment portfolio. 1% of cuts is 10%, 10 grand less of interest you're going to have to pay, which is probably now still making that investment property affordable. So you don't have to sort of sell. And even for a home loan, right? A 1% off your rate's going to be. But if, for example, there is 4 or 5 cuts on top of the one already, plus there's a real pressure on APRA to reduce the serviceability buffer, then you are going to see, I believe, a little mini boom in prices. I just don't see how you could increase what people can borrow that much and build that much confidence, is that you're going to see a lot of FOMO in the market. And usually when increased demand on a small number of listings, I think the prices only go one way. Is that what you're thinking too, Pete?
It is. I might just segue into the third story, though. I'm going to try and play devil's advocate here and try and look at the opposite scenario. So, third story of the week, Luci Ellis at Westpac. This was actually before the inflation figures, put out a note saying, lock it in, Reserve Bank is to cut in May. Previously, the RBA has been pretty hawkish to kill off inflation, but now I think the risks have tilted away from an inflationary breakout and more towards an economic slowdown. So, I think the US GDP was actually negative. It was reported this week, and therefore it's probably more prudent to start cutting rates from May. And that's Westpac's view. It's actually all the major banks are sort of looking at that. I'm just trying to sort of see the other side. I guess, tariffs, there's one thing, who knows? Like, everyone's saying this will create a slowdown in global trade, and clearly it has done so far, but maybe tariffs have a different impact from what people think. I think another potential risk to the narrative is, let's say we continue on this kind of big Australia program that does seem to be the way we're going. I mean, we could see population pressures keeping inflation stickier than what people think, I suppose. That's been, if you think of what the Labor government has been doing over the last 3 years, big spending, lots of investments in things like NDIS. In fact, the inflation figures show this. Goods prices are kind of on the way down, but a lot of the areas where there's government involvement or government investment, there's quite a bit of inflation still around. Health, education, various other bits and pieces where you can see government fingerprints. I just wonder whether sort of that, the big immigration story is going to keep pressure on things like construction costs, materials, the need for infrastructure and all of that kind of thing. So, look, I guess, markets are saying cash rates going to under 3%. I'm just wondering whether there might be another side to that story.
Yeah, and I wonder whether, there's just pressure with our exchange rates, right? So if rates around the world get cut a lot harder, does that basically, create a bit of a issue with our exchange rate staying a bit stronger, right? Because our rates are staying higher and things like that. So we pressurized to cut rates to improve our exports, right? So I think this is just the issue. It's even if you're cutting rates, it means we're only just affecting households, right, and their interest. And there's a lot of other impacts on the economy. It affects interest rates, it affects the demand for investment, and there's so many other things that interest rates affect. So I don't know, Pete, even if Australia does stay sticky compared to the rest of the world, does that also mean that our, is upward pressure on our exchange rate? What do you think there?
Yeah, I mean, the dollar's been on an absolute roller coaster ride through April. I think it started at around 63 cents. At one stage, we were at 59, and the Australia Institute was out there calling for an emergency RBA meeting, cut rates further. And then actually, as the tariff turmoil kind of calmed down a bit, the dollars went all the way back up to 64 cents to close out the month. So very hard to predict, I would say. I mean, the way it usually goes is if you see a big fall in the Aussie dollar, there is a risk of importing some inflation, but today that hasn't really been a factor. Plus, a lot of businesses hedge anyway. I mean, my gut feel is that we kind of, we're impacted an awful lot by what happens in China. And so far, anyway, Trump's moves have been negative for China, and therefore a slowdown in China probably has a knock-on impact to us in terms of our exports and so on. I think it was interesting to note the ABS put out some figures this week on Australia's overseas-born population. And we did have a number of years there where Chinese migrants to Australia basically stopped for various reasons. I think the relationship changed a bit under the sort of Morrison government. And then we had the COVID impacts, which stopped people coming. But even so, if you look out over the decade, big increase in the Chinese population in Australia. And the really big move has been in Indian born residents in Australia that have gone from 411,000 to 916,000 over the course of 10 years. So basically within the next year, that will be the biggest source country person by country of birth. That will overtake England as the sort of 10-pound poms drop away. But yeah, the Chinese figures are on the way back up again now. So yeah, I guess there's a lot of moving parts there. But I guess this is when you look at it, that's 31.5% of residents now born overseas, including myself. So I mean, that's another increase. So that seems to be, when you're looking at housing markets and demographics, this is such a massive story now that we're effectively turning into sort of an Asian Australia, much more so than that European Australia that was the case 25 years ago.
Yeah, I think the other thing to make a point on this, Pete, is it's all going to run out, and then, decisions are going to be made over the next couple of months, and even the next couple of weeks. We're going to start to see sentiment change, and the markets are expecting some significant cuts between now and even November, right? So we're really on the tail end of this in sort of inflation challenge, I guess, and whether it comes down as fast as what people expect or not, I think, we're going to know over the next 6 to 7 months. I would say that would be my bet. And if it does go down the way the markets are thinking right now, you're probably going to wish that you better buying would have been, 6 or 12 months ago, when there was a lot more uncertainty in the market, tighter borrowing capacity, a lot more fear. And whereas confidence is going to build, every cut's going to build confidence. And that's what we've seen with the first one. But I think people are going to want to see 2 or 3. And so no one's really trying to celebrate too early, because they got caught out in 24 when they thought rates were coming. They got caught out in 22 when rates went up a lot faster than they were expecting. And they got caught out when they dropped really fast, right, as well. So I think everyone wants just to see the rate cuts actually happen first.
Well, it's a good point. I think auction clearance rates this past week were at a 4-month low. And of course, we've had disruption from election, Anzac weekend, also Easter weekend. So it's not a very good bellwether or marker for market sentiment. But I think a lot of people are struggling with the higher mortgage rates. Chris, before we wrap up, let's try and cover a couple of the listener Q&A questions. So got a bit of time to finish up with these. So thanks for sending in the questions. You can get in contact via the show notes, and or send us your questions in the Rask community chat rooms there. We would like to sort of cover off whatever you're asking or talking about. So first question this week from Borrowed. Chris, what is the difference between an offset and a redraw? So I guess there are both ways in which you can save interest on a home loan, but there's a slight difference, I guess, in the treatment for a redraw facility when you've made extra home loan repayments. But you're the mortgage guy. I'll let you explain.
Look, it's an interesting one. I think either way, putting money into an offset account and putting money into a redraw basically does the same thing from an interest point of view. Both are paying off your loans, but doing it in different ways. A redraw is actually putting money extra into your mortgage. So let's say I had $1 million mortgage and you put $50,000 into the mortgage and reduce it down to $950. You could potentially still redraw that $50,000. Now, it does depend on the bank and their policies, etc. But what you're doing is reducing your loan. And then if the bank, because you're getting ahead of your mortgage repayments, and your bank's saying, well, I know you put it in, but if you do want to take it back out, that's okay. You can do that. You can redraw it. But you've got to be a bit careful. Redraw rules do change, and they can change bank to bank, and there's sometimes limits, and there's some changes CBA did a few years ago. ME Bank got in a bit of trouble because they changed the rules around it. So just be careful when you're doing it, because it might not be as easy as you think to get the money out. Often it is. So let's just put that one side. What you're also doing is paying down the deductible debt on that property as well, if it ever becomes an investment property, because when you're putting money into redraw or paying your mortgage off, you're actually paying the mortgage off. Yes, you could redraw it potentially, but that money, what you redraw that money for, is going to determine whether that is deductible or not. If you redraw and buy shares, well, and as an investment, then it's deductible. But if you redraw off an investment property to go on holidays or to help you cover mortgage repayments, that's not deductible. So just be really careful there with redraw. Offset account's the opposite. Instead of paying the loan down, that money goes into a savings account that you don't get interest on, but it offsets your mortgage interest. Every day the bank says, right, you owe us $1 million, you've got $50,000 in your offset account. And even though banks charge interest often, monthly, they accrue it daily. So every day it's calculated. So they would say on that day, you had $1 million of debt owing, $50,000 in the offset, you owe us $950, we're going to charge you interest on $950. If the next day you went and put an extra $50,000 in, then that would reduce your interest immediately. So often there's a lot of myths around offset account loans are more expensive than normal loans. That's just not the case. Once you go into a package loan and you negotiate your rate with the bank, you often can get just as good rates, if not better, than non-offset account loans. And so there's not usually a cost to offset account. Sometimes there's a package fee, which might be $200, $300, $400 a year. But I mean, when you're paying, interest on a $500,000 mortgage, that's about $30,000 a year of interest at 6%. If you've got $1 million mortgage, it's about $60,000 a year of interest right now. So $400 of package fees aren't going to move the needle much, right? And so the benefit of an offset account is it's a savings account. It's your money. The bank can't touch it. And if you ever wanted to, use that tax deductible debt, you haven't paid it off. If you ever want to need the money, you can take it out of the offset account. You can move it around different properties, and you've got much more flexibility. The problem with offset accounts, I find, is just a behavioral issue. Sometimes people get sticky fingers. They don't separate their money. They mix it all together, and they never actually get ahead of their mortgage because they're constantly just living out of their offset account. And yeah, they save 20 grand, but then they spend it. And so if you haven't really got a structure in the way that you do your savings and you manage your money, offset accounts can be a little bit of a problem. And banks know that. Banks know that people often don't use their offset accounts the right way and they end up spending the money. And so if you're in that position, sometimes it's better to just try to pay your mortgage off as fast as you can, rather than because when you see your mortgage getting paid down, it seems a little bit harder mentally to say, I'm going to increase my mortgage to go and do some lifestyle spending. When it's in the offset account, I feel like people are a little bit more lax on it.
Behavioral economics, right?
Yeah, that's right. And so I think that's the kind of the crux of it, really.
Yeah, perfectly summarized. Thanks, Chris. So let's do one more question before we wrap up from Melbourneite. I'm looking to buy a cheap-ish investment property in Melbourne. Are apartments worse investments? Yeah, so I think, generally speaking, houses have done better in Melbourne. That's true. I think where people get good results with units, it's generally been, or apartments, sort of the more boutique blocks in the leafy, family-friendly suburbs. I think the 1970s blocks have sometimes done well. Quite topical, actually. Kate Bakos, buyer's agent in Melbourne, did a Sunday blog on very much this topic, really, this week.
Right.
So we'll link to that in the notes. She says, during the 10-year period to 2022, apartment price growth was subdued in Melbourne. But recent sales suggest that apartments in established boutique blocks are appreciating in value. She just goes through 8 reasons for the sort of widely established and boutique older style apartments, their preferred picks. I mean, it's generally the livability thing. They're solidly built, generous room sizes, reasonable strata fees. You're getting a decent chunk of land value. And also potentially on the sort of smaller blocks, you've got more opportunity to be involved in the strata scheme. I think, as Kate points out, the things to really generally avoid are some of those big high-rise developments where you've got expensive strata fee. Well, all the opposite things, really. You've got no influence on the body corporate. You've got, less in the way of livability quite often. The strata fees can be a punish and all of those things. So, I mean, Kate lists various things there that you would look for. But yeah, I mean, I've said on another podcast, the types of areas I like in Melbourne, not really reinventing the wheel, but if I was buying somewhere there, it'd be like Prahran or somewhere like that, where you've got a nice apartment with a parking space, maybe a 2-bedder, pretty affordable, really, all things considered, and just that walkability, sort of, very livable kind of areas. But what do you reckon, Chris? I guess if you've got the budget, go for a house, but if not, maybe that's the way to go.
Look, I've been a little bit against Melbourne apartments for 20 years. And I was living down there when I first started to learn about property, when Kate Bakos, which you mentioned before, took me to a few open homes and sort of started to firstly explain to me how the market works back in 2011, sort of 12 time. And look, I think that they've performed really poorly over the last sort of 10, 13 years. And unfortunately, Melbourne's still pretty flat. It's pretty big and it's pretty relaxed on its planning controls. And I think as soon as the apartment prices do go up, then I think you'll see a development boom. So you might get a little bit of running prices, but I think on the back of higher prices, you get more supply. And can you really outrun Melbourne supply? I don't think you can. If I was going to buy in Melbourne, I'd absolutely be trying to get into the housing market. That's just the reality. And secondly, if I couldn't get into the housing market, I'd be looking at the villa unit market, which is basically not too far more expensive than apartments. They're they're very common in Melbourne and even in affluent suburbs that aren't building many apartments. You could have, row of heritage house, heritage house, heritage house. And then you have this 4 block of villa units on a great street that are low rise. They're 2-bedders. Yeah, they've got a tiny little backyard, but you've got some parking off street. And in the past, they maybe were bought by the more affordable part of the market, and maybe a lot of downsizers and divorcees and single parent families, etc., would buy them, and childless families. But I reckon the family market's forced there now. It's becoming like a real stepping stone option because they can still live in an affluent area, an area that they really are close to the city and the lifestyle benefits of living in Melbourne, but it's still affordable. And they've still got a bit of backyard. They've still got good privacy. It's a bit quieter. And I think that's the way I'd be entering the Melbourne market. I'd really be trying to avoid the apartment market. I know that there's a lot of argument that the intrinsic value of the land, when you cut up like you say in somewhere like Paran, the value of the land's worth a lot of money, and if all 8 apartments could sell, they could probably knock down the apartment block and sell it to someone wanting to build a house on it, right? But unfortunately, it's not that simple. I feel that even if the intrinsic land value is going up, it doesn't mean that often you could sell the apartment for more unless there's a real lack of apartments for sale and more demand, or you're selling it to a developer or something like that. But I'd be trying to go into the housing market and the villa unit market in particular in Melbourne.
Well, it's good advice. Funnily enough, I actually have some money knocking around in my super fund, so maybe I'll be a good case study over the next few months because, I guess I'm always the sort of person I don't believe in saying one thing and doing another. So, I'll keep you posted on what happens with that. So, what's on this weekend? I'm just heading down to Brisbane today for the women's State of Origin and then catching up with the guys in the team in Brisbane as well. But, it's election weekend, so no doubt the kids will use that as an excuse to stay up till all hours. So you probably will end up my body clock all over the place and watching the Grand Prix. So what's on for you, Chris?
Not much. I think I've got 3 birthday parties, playing football on Sunday, and hopefully get some good weather. It's been never stopped raining. It's finally stopped raining this morning in Sydney, so we'll see. And enjoy Liverpool being champions. I thought I'd just throw it in one more time. But look forward to chatting next week, Pete, and happy Sunday to everyone. Thanks for listening.
Cheers, and send in your questions and we'll see you next time around. Cheers, Chris.
Thanks, Pete.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.